Good morning, everybody. Mr. Sandeep Ghosh and friends from the financial community. A very warm good morning to each one of you once again. It is always a pleasure to be with the market participants. That way, we as regulators constantly get feedback, useful ideas and comments about our various regulations. So these feedback certainly go into policy making. I look forward to be interacting with that. Every profession around the world has been undergoing a lot of changes, be it the medical profession or chartered accountants or lawyers or financial sector. Specialization has become the part of the game. We talk about eye specialist, we used to talk about eye specialist, heart specialist, etc. Now, within that itself, further specialization have come on. Same way in lawyers also. There used to be tax lawyers. Now, within the tax also, sales tax lawyers or service tax lawyers. Within that also, further specialization. Because the world is so dynamic, it is becoming more and more complex. Every profession requires a continued specialization. I used to tell my colleagues in the bank whenever I may meet in this kind of situations. When we all joined the bank, our careers, when we started our careers, we were never compelled to learn and relearn. Whatever we achieved during our academic career, that was sufficient to carry us through all these 30-odd years. No longer it is going to be the case. I used to tell the new recruits, every 10 years you may have to learn and relearn and unlearn. So constant, continuous updating of knowledge is going to be an important feature of the financial sector. So that is why institutions and organizations like all those are represented here and NASM and so many others have the big challenge to cater to the increasing demand for continuous knowledge updation. So I am very glad that all of you have thought it fit to organize this summit focusing on the credit market. The role of the financial system is to intermediate between lenders and borrowers and provide avenues for saving and help investors find their financing needs. The financial markets impact growth by channeling saving to firms and improving the allocation of capital. Moreover, efficient financial markets and institutions tend to lower search and transaction cost in the economy. As the industrialized nations' economies grew in the 18th, 19th, and 20th centuries, their financial system also grew in depth and breadth. In the 19th century, London achieved its status as the world's leading financial center because the financial sector had developed rapidly in order to serve the needs of the British industry and British exporters. Similar is the case with the 20th century New York, which played a similar role in relation to the American economy. The relationship between financial development and economic growth is a subject of debate. Some economists just do not believe that the financial growth relationship is important. For instance, Robert Lucas asserted in 1988 that economists badly overstress the role of financial factors in economic growth. Moreover, Nobel laureate John Robertson declared in 1952 that where enterprises leads, finance follows. According to this view, economic development creates demands for particular types of financial arrangements, and the financial system responds automatically to those demands. The well-known former editor of The Economist, Walter Bagehot, expressed like this. In 1873 itself, he mentioned like this. In England, however, capital runs as surely and instantly where it is most wanted and where there is most to be made of it, as water runs to find its level. However, it is now increasingly accepted that financial development has a positive effect on growth. Financial intermediation can affect economic growth by acting on the saving ratio, on the fraction of saving channel for investment, and on the social marginal productivity of investment. The studies of McKinnon and Shaw in early 70s propounded that financial repression depresses growth, Conversely, financial development should raise growth. A positive correlation between growth and indicators of financial development is well documented. A growing body of evidence suggests that financial institutions such as banks and insurance companies and financial markets, including stock market, bond market, and derivative markets, exert a powerful influence on economic development, poverty alleviation, and economic stability. The position holds good for India also. It is imperative that our nation must achieve high economic growth to cater to growing aspirations of the people. To attain such growth, large capital and efficient distribution of capital are needed, which can only be possible through efficient and developed financial markets. World Economic Forum has constructed an index that measures financial development. Measures of financial development are captured across the 7 pillars of the index. Why they are institutional environment, business environment, financial stability, banking financial services, non-banking financial services, financial market, and financial access. India is ranked 40th among the 62 countries in the World Financial Development Index of 2012. While there may be debate on the methodology of ranking and the relative importance one may give to these rankings, it is pertinent to recognize the fact that there is tremendous scope for improvement. There is a need for working together in building more efficient financial markets. Characteristics of financial market development inter alia include 1. Size of financial institutions and markets, that is a financial depth. 2. Degree to which individuals can and do use financial institutions and markets, that is access. Third, efficiency of financial institutions and markets in providing financial services, that is efficiency. And fourth, lastly, stability of financial institutions and markets, that is market stability. Some of the parameters on financial development indicators from World Bank database with regard to India, I have given in the annex, that's fine. Okay. Market development is also dependent on the structure of the market and preferences of savers for intermediation. In Asian economies, there is a marked preference for bank intermediation. Bank-based finance has a special role to play for many economies in need of capital and thus helps to ensure a well-balanced growth process. Benefit of bank-based finance relates to the intrinsic nature of the banking business. Some projects cannot be financed directly by the market on account of significant information asymmetries between the borrowers and the lending groups. Banks can bridge this gap thanks to their comparative advantages in the assessment and monitoring of investment projects, which contributes to overcoming information asymmetries. Further, the economic literature on relationship banking has demonstrated that banks can contribute to alleviating the impact of sudden economic shocks on their clients. Banks are, however, financial intermediaries that by nature add cost to the allocation of capital. In Asian economies, banking is a marvelous mechanism for channeling into productive investments the huge flow of household savings generated. Since those economies, including mainland China, have saving to income ratios that are 3, 4, or even 5 times more than those of the rates in the other countries in the West. For all its potential contributions to economic growth, banking remains fragile. The high leverage combined with their extreme mismatch of maturities, that is funding long-term assets with short-term and in some cases foreign currency denominated liabilities and reliance on demand deposits makes them inherently vulnerable and their economies to severe and recurring credit crunches. Although banks play an important role in these economies by channeling funds from depositors to companies without access to capital market, banking itself, says Nobel laureate Merton Miller from University of Chicago, he says, banking is basically a 19th century technology. Today's emerging Asian economies do not have well-developed capital markets and so remain heavily dependent on their banking systems to finance growth. However, as Miller argues, countries should develop a well-fleshed out set of financial markets and associated institutions. According to an Asian Development Bank study, the initiative to develop bond markets should focus on sustaining a stable macroeconomic environment with low inflation and stable interest rates, developing a healthy government bond market that would serve as a benchmark for the corporate bond market, completing the post-crisis agenda of banking sector restructuring, improving corporate governance, strengthening the regulatory framework for bond market, rationalizing tax treatment of bonds, broadening the investor base, and promoting the growth of regional bond market centers. Indian markets, bank credit. India has the distinction of a long history of both banks and capital market. Economic history of India narrates how both have been vibrant in many important cities, though Mumbai has been dominating all others. Slowly and steadily, especially after nationalization, the banking sector has emerged as the source for investment. In India, bank credit has been the significant contributor to the investment process. Bank credit increased from 5 billion rupees as at the end of March 1951. It tripled by 1961 to 13 billion. Then again it tripled to 47 billion by 1971, then 5 times to 254 billion by 1981. That every 10 years the growth has been much faster. And 1,164 billion by March 91, 5,114 billion by March 2001, 39,420 billion by March 2011, and as of last March, that is March 2014, the bank credit has risen to 67 trillion rupees. What has been the contribution of capital market during these years as compared to the banking? During the 1970s, because I don't have data for earlier years, during the 1970s, while capital market helped raising 10 billion rupees, that is from the primary market, worth of equity, bonds and debentures, corresponding period, banks extended credit worth about 207 billion rupees. During the 1980s, the corresponding figures were 233 billion in the securities market and 910 billion in the banking market. In the 90s, they were 1,172 billion vis-a-vis 3,950 billion. And in 2000s, they were 2,115 billion in securities market and 34,206 billion in the banking market. In 2013-14, it was 556 billion in the capital market and 9,556 billion in the banking market. While the capital market has been disappointing, that is a primary market, the private placement market in the past 20 years has been good. Though the issues thereat had been predominantly in the form of bonds and debentures, the growth in size has been very reassuring. It gained popularity from mid-1990s. From 1995-96 to 2000-2001, this market raised about 752 billion. In the next 10 years, it helped raise 7,614 billion. That is 10 times during the next 10 years. And in the fiscal 2013-14, this market raised about 3,900 billion rupees. Thus, the primary engine for Indian investment is in the credit market. Despite all our efforts to develop corporate debt market and calibrated increase in foreign capital, credit market remains the bulwark of Indian investment scenario. OTC market. In India, the small size of the OTC derivatives market, low level of complexity in products, and regulatory structure that mandates that validity of any OTC derivative contract is contingent on one of the parties to be in the transaction being a regulated entity resulted in orderly development of the derivatives market and lessen the concerns with regard to the systemic risk. The OTC derivative products were introduced in a phased manner, keeping in view the hedging needs of the real sector. Reserve Bank has focused on improving transparency and reducing counterparty risk in the OTC derivative markets and fostered development of robust market infrastructure for trading, settlement, and reporting of transactions. As India is committed to implementation of the G20 and FSP reforms, reasonable progress has been made in implementing the OTC derivative reforms measures in India. The status of reforms is as follows. Standardization. The process of standardization is planned to be undertaken gradually. CDS transactions are standardized in terms of documentation, coupon payment date, etc. IRS on overnight index swap have already been standardized. Other benchmarks in IRS would be standardized in a phased manner. Central clearing. Calibrated steps towards central clearing of OTC derivative transactions are being undertaken. More than 70% of IRS trades currently being centrally cleared without regulatory mandate. CDS market is still developing, and it may take more time to achieve the necessary market activity to support central clearing of CDS transactions. Time frame for guaranteed settlement of CDS will be mandated after a critical level of volume is attained. Exchange or electronic platform for trading. Electronic platforms are available for transactions involving repos in government securities, IRS, forward rate agreements, and foreign exchange forwards. Report of the working group on government securities and interest rates derivative markets, which I had the privilege of chairing, has also recommended introduction of an electronic swap execution facility, that is electronic trading platform, for the IRS market, and consider introduction of a CCP which may provide guaranteed settlement of trades executed through the electronic platforms. Work is already underway on this. Reporting to trade repositories. As per existing regulatory guidelines, banks and primary dealers report IRS and FRA and foreign exchange derivative transaction on CCL reporting platforms. With regard to CDS, all market makers must report all trades, including client trades, on the CCL's reporting platform. Presently, client trades in IRS are also being reported by banks. I am sure in this summit, you will all be discussing the credit investment market infrastructure, the various opportunities and challenges that the credit investment market offers, and how to benefit out of this important segment of the financial sector. I wish you all a useful deliberation for the rest of the day. Thank you all for your attention.